Our speaker this afternoon is Bob Crutchfield, the Managing Director of the Bright Edge Fund. The Bright Edge Fund is an organization that is owned by the Atlanta-based the American Cancer Society. Its mission is to invest in companies that create innovative mechanisms of treating cancer. Mr. Crutchfield has had an illustrious career. He is a graduate of the University of Georgia. In 1995, he founded Surgical Innovations and Services and has served on the boards of numerous organizations such as SHIPT. We are delighted to have him with us this afternoon and look forward to learning about the important work on how he and his organization use finance to improve public health. Please give a warm Georgia Tech welcome to our guest, the incomparable Mr. Bob Crutchfield.
Hey. I want you everywhere I go. That was really good. Thank you very much. It's a real pleasure to be here. Today you get to see a really tired venture capitalist. So I was up in New York the last couple of days fundraising, so pitching to the banks about our new fund. But it's a real thrill to be here, and I'm sorry I was a little bit late. How many people know what the Cancer Society is, who we are, and that we're in Atlanta, and that's our global headquarters? Okay, so let me ask you another question. How many people in this room have been touched directly or indirectly by cancer? Yes, I mean, it's just literally just about every single person. So cancer today is the second leading cause of death. Even though the death rate is bending downward since 2011, the death curve has bent about 27% through last year. But it's still, the incidence rate is climbing rapidly. So I was an institutional venture capitalist. Do people know what institutional venture capital is? So institutional venture capital is where you are a general partner in a fund and you raise money from endowment funds, retirement plans, and then they give you a portion of the dollars that they have in their plans to put to work in something called alternative assets. And so private equity, venture capital, real estate, timber, those are forms of alternative assets. So I had done that for a while and had an opportunity to interview for a role to lead and launch this new fund for the American Cancer Society. And so I think as we walk through this, you'll see why I'm having so much fun investing for both mission and returns. And I like dialogue, so if there's a question you have as we're going through, it's like my children say, it frightens them that I make any portion of my living by communicating. So if something's not clear, just stop me and let me know. So Bright Edge, we're the impact fund manager for the American Cancer Society's Bright Edge Fund. And the reason Bright Edge was formed is, and we launched in fourth quarter of 2018. The reason we were formed is that if you're a cancer patient today, you don't really care much about research. So the Cancer Society's done a great job since 1946. We've deployed over $5 billion in research grants and put it into the hands of some of the best and brightest researchers in the world. And those researchers are working on big problems facing cancer patients today, really thinking and looking towards tomorrow's treatments. But as a cancer survivor myself, if you have cancer today, you don't want to wait till tomorrow. You want today's treatments. So over $20 billion has been put into the oncology space by private capital over the last 5 to 7 years, and we saw an opportunity to expand our research funding into investment in for-profit companies with for-profit investors to both drive mission in terms of accelerating patient access to these novel and innovative diagnostics and therapeutics so that the commercial adoption cycle is shortened, and then to create a sustainable new revenue fund for stream for the American Cancer Society. So one of the big problems in oncology especially is that in 2019 there were 843 venture capital backed companies that investments that were made just in 2019. If you're a company that gets to the clinic, so of that 843, less than 35% will get to some clinical trial. And then of that 35%, less than 6% will actually get into the market. So get an FDA approval so that you can use this product in patients. And often the trials fail for the wrong reasons. It's not because it's bad science, not because it didn't work. It's that things like clinical trial enrollment is too shallow. They don't have enough patients. And then clinical trials are very focused in terms of the patients that they're trying to enroll. There's a particular type of patient. And so there's only room for 120,000 patients in clinical trials in the U.S. today. That sounds like a big number, but there aren't enough patients to fund and fuel all these trials. So what we're trying to do is literally bring our resources behind the brand to work for the companies we're investing in to help create efficient clinical trial programs so that we can actually help clinical trial sites be identified, researchers identified, and investigators who can run those trials, and then help accelerate the enrollment of those trials. So we talked about what the Cancer Society is doing with research. So today we deploy over $100 million a year into research grants. There are over 1,700 active grants that are in play today. And we've got a new program that's part of research that if you're a grantee who's been funded and you have an opportunity to do early stage clinical trials, in human trials, not necessarily an FDA pathway, but just more proof of concept, and there are special cases where the FDA will approve that, we'll put additional funding into those programs. But those are Launch and Boost are all programs that are done inside research universities. These are not commercial products. What Accelerate is we're investing in for-profit companies. So when I say a for-profit company, it means a company that has a corporate structure around it. Generally, these are LLCs or Delaware corporations. We're following the investors like Andreessen Horowitz, Polaris, RA, Perceptive, 5AM, NEA. These are some of the biggest names in the world that are doing life science investing. And so we're putting our capital to work alongside these great investors, and then we're bringing our resources to bear to help these companies grow. So the first thing we do when we're looking at a deal is we think about, is there a mission impact? And so mission is sort of gating hurdle one. So if it doesn't meet a mission, we're identifying an unmet addressable market opportunity, whether that's like Castle Biosciences, which we'll talk about in a minute, that was meeting a need in classification of metastasis risk for cutaneous melanoma patients, or if it's a company like Freenome that's in the blood-based liquid biopsy space for colorectal screening. We're bringing resources to bear to help these companies grow. So mission is first. Second is sort of the second side of our mission coin. So first side of the coin is patients. Second side of the coin is if we underwrite for mission well and patients begin getting treated at scale, or we have promising clinical trial results and we can do an initial public offering, then there is a financial reward on the back end for the American Cancer Society. So we can either reinvest and recycle those proceeds from liquidity, that's what it's called when you sell a company, or we can spend those dollars out back into other things that the Cancer Society is doing. So it's a pretty interesting model where you get to have three bottom lines. So we get the first bottom line on mission, second bottom line on financial returns, then that third bottom line on the boost that we get when those dollars are recycled back into the American Cancer Society for other life-saving work that we're doing. So we talk about these resources behind the brand. So, everybody wants us in their deals. I feel like the most popular investor on the planet because I've got this American Cancer Society brand behind me, and it is a big, big brand. It's a 107-year-old, literally storied brand, high integrity. The work we've done over the years as a society to help advance early detection and prevention, some of the case studies we've done linking cigarette smoking to lung cancer. I mean, it is a highly respected, globally recognized brand. And when we're in a deal, what happens is we elevate market awareness. So you guys have done some marketing work, I guess, in your studies. And so you know the importance of brand linkage and what that can do to give lift to a company. When we get into a deal, the lens through which patients and providers and payers see that company is shifted because they're looking at it through the optics of the American Cancer Society. So everybody wants us in their deals. We'll see 1,000 investment opportunities in 2020 alone, and we'll only be able to do 4 to 5 investments. So our deselection rate is very, very high. But when we get in a deal, what we want to do is bring, like we were talking about, those resources to bear. So what are those resources? We have 4 mission pillars in the society today. So one is our Cancer Action Network. That's our policy and advocacy group. They're based in Washington, D.C. So we can give our management teams and the companies we're in direct access to legislators. We can give them direct access to folks in National Institutes for Health or the National Cancer Institute. We can help them with pre-regulatory pathway meetings with the FDA. I mean, there are just tons of things we can do based on the relationships those people have. The other thing is that we talked about was the brand. The brand itself creates tremendous value. Castle Biosciences was a deal we invested in. We invested in March. By the end of April, or in early May, when they were looking at the April numbers, just by having us in the deal, they had seen a 4% month-over-month increase in the number of orders that were occurring because dermatologists were getting more comfortable with the test as a function of us being in that deal. Clinical trials, we talked a little bit about that, but we can actually advance clinical trial site development and clinical trial enrollment. And then governance. So if all of our companies have boards, and then all of our companies have scientific advisory boards, we can go through our thousands and thousands of investigators and find the absolute perfect fit for a company that's looking for a particular scientist with deep domain expertise in a particular area of cancer. And so these types of value-added services and effort that we bring to a deal, have you guys studied, creation of alpha and value and those kind of things? So these resources, when we put them to work, we actually increase the value of the companies we're in because we're speeding up the commercialization process. So it's a really big deal. Andreessen Horowitz can't do this. Even though they're a multi-billion-dollar investment shop, they can't do it. Third Rock can't do this. So it's a real thrill to be able to bring these types of extra value-added components to the table. So this is our team. It's a small team. We hired Mike Krebs, who joined us not too long ago, came out of Charles River Associates. And then before that, he was in the Department of Defense working on, top secret things. He won't, he can't tell us. But he's a very bright geneticist and really helps us on underwriting the science. We're looking at deals. And then Daniel Krebs, or Daniel Coley, came to us out of Robinson Humphrey. He's our senior analyst, and he's sort of the prototypical senior analyst in an investment shop. He spent a couple years in investment banking, so he knows how to do modeling and helps us with a lot of the back office work that we do. So our scientific advisory board is crazy good. So I'll talk about Carl June. He's the father of CAR T, chimeric antigen receptor T cell immuno-oncology. Just think of it as there were patients that could not be treated with acute types of lymphoma, particularly in children. And he developed a solution with CAR T that it's absolutely curing patients who were on a death sentence just 5 years ago. So he is incredibly brilliant. He's probably a future Nobel Prize winner, one of the nicest guys on the planet, but I can call him up and he'll answer my phone calls. So, and then I'll point out Andrew Lowe on this slide. He is a brilliant economist out of MIT, recognized as one of the top 100 most influential people in the world. And he has these ideas around curing cancer. He believes we could create this global super fund because there's so many billions of dollars being invested every year in specific types of cancer companies. He believes if we just put all that money into one fund, invested in everything, that the economics would return far greater than the economics that we're getting by parsing the amount of capital across wide numbers of competitive deals. He thinks that would change the world, but he is a super person. So this is our portfolio. So we've made 5 investments. So we launched. We built the back office out in fourth quarter of 2018, and then we went to the J.P. Morgan Healthcare Conference, which is the largest healthcare conference in the country, one of the top 5 in the world, and then we presented what we're doing, and that got us into deal flow, and we started seeing a lot of deals. So Castle Biosciences, that was a late stage deal. We invested in March. In July of 2019, they did their IPO. They had a very successful initial public offering. The company's continuing to perform well. So if you have cutaneous melanoma, if you're diagnosed with cutaneous melanoma today, chances are you're going to be classified for risk as 1 or 2. So those are relatively on a scale. It's 1, 2, 3, 4. So if it's 3 and 4, it's you've got much higher risk for metastasis. You probably have some level of metastasis beyond where the tumor site is. But if you've got cutaneous melanoma, you're 92% of all patients are diagnosed stage 1, stage 2 for risk. But 78% of all the melanoma deaths are coming out of that lower risk classification pool. So there's a disconnect. And it's because of the antiquated way that pathologists and dermatologists today classify risk for metastasis. So Castle developed a gene expression profile test, and with 85% accuracy, it can tell you if you have risk for metastasis. So if you're a stage 2 patient, today what happens is, because nobody knows if you're really a stage 2 patient or not, you go through this surgical procedure called a sentinel lymph node biopsy. They're very painful, very expensive surgical procedure, about $25,000, long recovery period, so pain and morbidity. And probably 60 to 70% of those sentinel lymph node biopsies that are being performed today are unnecessary. They come back inconclusive. So what Castle's able to do now is says, if you're a stage 2 melanoma patient, cutaneous melanoma patient, and you have literally low to no risk for metastasis, you and your provider are going to manage your diagnosis differently. You're probably not going to get a sentinel lymph node biopsy. On the other hand, if you're stage 1 with an 80% chance of metastasis risk, you're going to change the way that you and your provider manage your diagnosis. So at the end of the day, what that means in terms of mission is, 1, we're helping patients avoid unnecessary surgical procedures. But the other thing that we're doing is we believe that we're bending the death curve out of the population that has been diagnosed with Castle, use their diagnostic, versus the broader population that is not being treated or diagnosed with Castle. So part of what we measure, aside from just the financial metrics on performance of the investment, is we measure the impact metrics on the performance of the company with regard to the lives that we're trying to save and the dollars we're trying to save in terms of unnecessary surgical procedures. So Freenome is another cool company. It's where the collision of biology and AI is occurring at a rapid pace. So what Freenome has done is they've identified 7 biomarkers related to colorectal cancer. So those biomarkers are everything from RNA and DNA to cellular fragments. And so all of those biomarkers put off a signal as it relates to colorectal cancer. And they've built an incredible sequencing capability and an incredible predictive algorithm that they can actually now take a blood-based, small amount of blood, just like you would do if you went to the doctor and did a physical, small amount of blood, just a single vial or 2, and they can tell you with 95% specificity and sensitivity whether you have colorectal cancer or not. At a stage 0, which means that it's not even recognizable by any other means of detection today, up to a stage 3 or 4. But early detection is the key, because if we can identify patients with colorectal cancer before they become a stage 3 or stage 4 patient, the prognosis for those patients for long-term progression-free survival is incredibly good. In fact, the cure rates are very good for those patients. So again, mission is the first gate that we use for deciding whether or not we wanted to do this deal. And then the quality of the management team and the technology they developed behind it was really, really cool. Navigating Cancer is a healthcare IT company. So Castle is in Houston, Freenome is out on the West Coast in the Bay Area. Navigating Cancer is in Seattle. They're a company that has developed software that will link a patient to an app, tie them into their patient's EMR. That's not spectacular or magical. But what they've done is they've developed a way for patients. So if you are on a cancer therapeutic, whether it's an infused agent or whether it's an oral agent, there's toxicity that occurs when your immune system is suppressed. And so the side effects are typically nausea, vomiting, and diarrhea at some level. And so if those get really, really bad, what a cancer patient will do is 2 things. One, they'll stop taking their meds, which is bad. And then they'll go to the emergency department, which is bad, because they're going to get hospitalized because they're so sick, which is bad. Because the last place you want to go if you're an immunosuppressed patient, meaning that you're highly, highly susceptible to infection because your immune system has been compromised, is to a hospital where you're like a germ factory. So this company allows for a digital approach to triaging patients as they go through these side effects. And then Community, which is a Carl June company, he co-founded this. This is taking what he had built with the CAR T that was really focused on blood-based cancers to now targeting solid tumors. I mean, this is a massive step forward scientifically. It's a massive step forward in terms of the number of patients that can be treated. And so we feel very strongly that this is going to be another great company, and it's out of Philadelphia. So we really care about bending the death curve. We care about patients avoiding unnecessary surgical procedures. We care about patients having democratized access to the most novel and innovative diagnostics and therapeutics that are available today. And so we're working really hard to level that playing field. And as an investor, I've never had the thrill of sitting in a seat where we actually can impact this stuff. I mean, this is not just a story. I'm not just telling you, some facts that to fill a void in a slot for a talk. I mean, we're really doing this stuff, and we're making a difference every day when we wake up. And we'll do another 4 or 5 deals in 2020. So that's sort of the story. I kind of blew through that fairly quickly. One of the things that's happening is that we originally envisioned the fund being a philanthropic donor-funded model, so that we'd go to donors and we'd say, hey, we want you to give us $1 million or more to put into this fund. We're recycling all of the proceeds, and we're going to build to some level of corpus that's going to allow for dollars to spin off. And donors looked at us and they said, well, so let me get this straight. You want me to give you $1 million or more. You're going to give me a tax deduction. You're going to show me where every dollar is invested. So you're going to treat me like a limited partner or an investor, like in these other funds. And then you're going to show me the boosting and compounding effect on my original donation. And then you're going to show me where those dollars are recycled. But you're not going to get, I get nothing for that. No additional tax credit, no anything. And yet I'm looking back at Andreessen Horowitz's investors, and I'm looking at Polaris's investors, and we're helping them make money. And so I want some of both, and which is a fair, argument. At some point you have enough money that, can't you just kind of roll a little over? It's been our argument, but it doesn't play well. And so that's what I was doing in New York, is that we're create a hybrid model here. I've got $50 million from the Cancer Society that we're working with today. We're going to continue to raise philanthropic dollars to fund the Cancer Society's investment capital. And then I was in New York meeting with all the big banks and some of the foundations and some of the endowments up there over the last few days. And we're going to raise money from them, I believe, that will be investment capital that will generate a return for the investors. So we're going through the evaluation of a model shift. It's not completely decided yet that we'll do that. But we're very much still in that startup phase where we're trying to get it figured out. So I'll pause there and see if there are any questions. I mean, this is sort of a technical kind of thing that we're doing, but I'd be happy to answer any questions.
Thank you so much. As we open the room for questions, please wait for a mic from me or Yuhi and to make your questions. So.
Hey, does anybody in the room have interest in being in the investment space, venture capital or private equity? Yeah. So I'd be happy to answer any questions you guys have about just the alternative asset world in general.
So basically what you were saying is that most of the investors that you've pitched to so far want to generate return. They won't they require interest basically.
Yeah, so the way this world works is that you have a general partner, which in our example would be the Bright Edge team, right? So we're the investment team. So we raise money from investors who believe we have the capability of going out into the market, investing in companies, and generating profits. So buy at X and sell at X plus Y, and then we get a management fee in the for-profit world of somewhere between 2.5% and 2% of all assets under management. We don't do that at Bright Edge. We have a budgeted management model. But then at the end of the fund, and these funds are typically 10-year fund lives, have a 10-year fund life. At the end of the fund, you sell everything, and then you look at were there profits. So if on a $200 million fund, if we were really, really successful, we would have generated returns of $300 million. So now you've got a $500 million pool to return. Of those $300 million in profits, the limited partners or the investors get 80% of those, and the general partner, Bright Edge, we get 20% of those. Well, that's a pretty nice payday, when that happens, but we don't get that at Bright Edge either. So those dollars flow through us back to the Cancer Society, but there's a lot of money that investors have the ability to make based on this mission-based impact model. At the same time, they're willing to allow for advantage economics for the Cancer Society, so they'll give up a little of their profit. And so that's what I've been working on with the banks up in New York, trying to figure out what that right balance is. But that's right. I mean, they don't want to just give. They'll it's easy for them to write checks for $50,000 or $100,000 for something. But when you ask them for $5 million, I mean, I don't care how rich you are, that's a big ask. And so even if they, it's a rounding error on their balance sheet, they still take that number, that size of number, very seriously.
Thanks.
Thank you so much, sir, for taking the time out to come out of your very busy schedule to come to Georgia Tech today. I had a quick couple questions based on, it's a corollary to her question. One, could you provide some context? Being that venture capital was started I believe in the 50s or the 60s, that was in an era, especially around the 70s, where interest rates were like double digit. So if you wanted to get a really great return, you had a numerous places to get that return. Now, with interest rates so low, and there's so many firms that intend to do venture capital, you have a lot of misplaced incentives. So a good example might be Theranos, where they have such short investment horizons. It incentivizes a lot of people to not pay attention to the details. versus like a LP like yourself, where you have enough brand recognition, but a lot of limited partners, like let's say a sovereign wealth fund, would trust you much more than they would Andreessen Horowitz or so on, or maybe even an Emory or Georgia Tech, where there's lots of graduate students that are much closer to the research and are actually, doing the experiments that they might feel a little bit more confident dealing with those folks. So can you kind of speak about that, about how things have changed and how you're trying to be like a voice for good?
So I almost want to hire you as a biz dev person. So it's a great story, and you've done your homework. So you're right. Venture capital is a relatively new financing field. So back in the late 50s, early 60s is where it really started to flourish. Really started growing through the 60s and the 70s. And what was happening back then is that something akin to what is happening today. Even though you could get capital, it was expensive. But if you had a company that was not making money, burning, right? You weren't making a profit because you were spending money to try to create that magical, outcome, then banks wouldn't loan you the money. And so what happened is these entrepreneurs started going to wealthy people and presenting, business plans that showed with the right amount of investment capital and the right time horizon so that you could finish the development of your concept and turn it into a product, you could actually make a lot of money. And so the investors would get large share. They would own large portions of these companies. So, Microsoft was a startup. Apple was a startup. And so the people that invested early in Apple and Microsoft, they had, pretty healthy equity stakes in those companies, so they made a lot of money. But they couldn't go to the banks. Those companies couldn't go to the banks and borrow money because they didn't have cash flow. So that hasn't changed today. What's changed today is that there is so much money coming into venture capital, billions and billions and billions of dollars. I mean, Andreessen Horowitz raised a $1.5 billion fund in probably less than a month. And then right on the heels of that, they raised a $750 million healthcare fund. So in like a week. So there's a lot of money coming in to the space. And so what does that mean, right? If you're managing $1.5 billion in a fund, so assets under management are $1.5 billion, you have to put that money to work in 5 years. So, I mean, that's a lot of dollars to be put to work. So what happens, right? So maybe you do get a little sloppy on your selection process. Maybe you do, overvalue a company because you're putting a little too much. You need to put the money out into the market, and maybe you're not quite as disciplined. So I think those are the kind of things that happen with a Theranos. Because there's so much money in these West Coast funds that it's easy to look optimistically and hear the story and believe it rather than really take the time of, a 4 to 6 month or even a year, tracking to get to know the management team, to get to know the science, to get to see performance. And I think that's where it happens. Yeah, so I think that's a very insightful comment. What we're doing is we're trying to bring, at least for the deals we're in, we're very rational on those deals. So we have a 40-point diligence checklist that covers everything from scientific underwriting of the management team, and underwriting of the business model, and then underwriting of the investment syndicate. So, and we will typically, early on, you don't have the luxury of, tracking a deal for 18 to 24 months like you like to. But Castle, that deal, I had tracked that deal for 3 years. So I knew the investment syndicate very well. That's how we got in. And so I knew the company, I knew the management team. They had good financial performance, they were making money. And so that was a whole different deal. But we do want to be very disciplined and stewardly because we're using today donor money. And we're putting that money to work in the market. And the other thing is we want to be a steward of the patients, because we really do want to bring value to the patients on the mission side. So that's a very insightful question. Thank you.
So I really appreciate and kind of like this sort of model of trying to actually look and going into these companies and projects for good, because a lot of times, I say this as someone who plays around in the market, but I see a lot of problems with, institutional investors and big funds and that sort of thing, and that they not only don't do their homework, but only care about kind of that short-term gain, especially when you're looking at something that's only going to run for 5 years. Do you think there could be any sort of movement or rules change or something to kind of move the general market, because there's not very many people doing what you're doing, but the more the general market to where people will actually look at stuff for the long term and actually not just a short-term gain, but the good of an overall system, good of overall, what's being made.
Yeah. So there are some things happening in the market with regard to length of fund life. So SV Life Sciences is working with the Alzheimer's and Dementia Discovery Fund, and they set their fund up as a 15-year fund because it takes so long to invest in an early therapeutic and see it get to its endpoint. So they wanted to have patient capital, and they wanted to be able to allow their management teams to drive through scientific inflection points and regulatory pathway inflection points. So that's pretty thoughtful. But there's so much money being made on management fees alone that venture capital firms, particularly these large ones, they're incentivized to put the money to work as fast as they can and then get back into the market to raise a new fund. So because what typically happens is you don't wait till the fund to complete. You're out raising money every 3 or 4 years for a new fund. So during the course of a 10-year fund life, you may have 3 or 4 active funds that you're carving management fees off of. So if you've got an aggregate of $5 billion in assets under management across 3 funds, and you're getting 2% management fees on $5 billion, you do the math. That's a pretty good number. And so you're getting wealthy just on raising management fees, the general partners are. And so, but then you've got another problem. It's like we're just talking about, you have to put that capital to work. And if you've got $5 billion in capital that you're trying to deploy into the market, you can't do that 10 million at a time. You can't, the round sizes that we're getting into today with these very sophisticated investors that we're investing with out on the West Coast, they're $160 million rounds. Because they have to put $40 or $50 million into a deal to be able to move the needle, and then they want to follow on with another $40 or $50 million. So I do think the scale has become a little bit of a barrier and somewhat problematic. I think investors are going to work it out. You're dealing with some of the most brilliant people in the world in these funds, so they'll figure it out. Investors will not put money into the funds if they don't perform. So, the market will solve itself. But I do think we've had some, very big losses, with like the Theranoses of the world, the WeWorks of the world. And they're not just 1 or 2 or 3. They're 6, 7, 8, 9, 10 of these big unicorns that have just, SoftBank has just gone through a little headache of their own. So there's a lot of stuff going on in the market where the market will right itself, but in terms of governance and regulation and those kind of things, I'm not sure that private capital is going to allow heavy regulation like you have for a bank to come in because it's risk capital. That's what we're putting to work. And then I think on this, do good in order to do well, I think the impact space is growing far more rapidly than the traditional private capital for-profit market. And so it'll be interesting to see what happens there. But there's globally there's over $1 trillion in impact fund money being put to work. So we'll see. It's a lot of money chasing deals.
Okay, so I had a quick question. So I know you talked earlier about the process of working with startups and stuff and choosing them, because you said you have a very high deselect rate for those. How do you balance out versus the knowledge that you have of each of the companies to actually choose which ones that you choose want to like partner with? Because I know they get like the benefit of like partnering with American Cancer Society, so that's their benefit. But like personally, for your side of like American Cancer Society, like how do y'all choose that?
Yeah, so in our shop, the first thing we say is that when you do an investment round, it's like a Series A, Series B, Series C. We won't lead any of the rounds. So we want to follow, an A16Z, or we want to follow, one of the larger groups. And then, but we're going to understand their math on valuation, those kind of things, and we leverage their underwriting on the science and all of that. But we want a good, high-quality outside financial lead. So that's gate one. If there's not a good, high-quality outside financial lead, whether it's a good for mission or not, we won't do it. Then the second is, does it meet an unmet, addressable market need where I believe and our team believes we can bring our resources to bear to accelerate patient access? So that's gate two. And then we really look at the science. And so some science is interesting and exciting, but it may or may not scale. And so we try to figure out, which ones of those won't. And then we try to figure out, you have science that's sort of avant-garde and ahead of the market today, but what's behind it that can jump over it and make it a bad investment. And then we go to the management teams, really understand, are they the right fit? Do they have the right background for the work that they're doing? And how well they communicate. Are they coachable? Are they people that you're going to feel good spending 7 or 8 years with? And then the last thing we do is we really try to understand what the financial returns are going to be.
So I have a question about the cancer treatment in general. So based on your opinion, like how much progress we're going to make for the cancer treatment, say in 5 years, 10 years, 20 years? And what's the biggest challenging for developing these new technologies, except the technical reasons, like based on your idea?
Yeah, so that's a good question. So I think we're in the decade of immuno-oncology. So things like checkpoint inhibitors, CAR T. There's so many T-cell companies on the market today doing advanced things. And so I think we're moving into this era of very targeted therapies where I think your genome and your genotype and your phenotype will be sequenced as a standard of care probably within the next 3 to 5 years. And so then that allows patients to be segmented around the defect in their DNA and RNA that is making them susceptible to whatever type of cancer that they have, but also makes them susceptible to making sure you've got the right treatment. So how many of you have heard of a drug called Keytruda? Jimmy Carter, our former president, is on Keytruda. That's a checkpoint inhibitor. It works on about 25% of the patients that receive it. So it's standard of care. So 75% of the patients who receive it don't have any benefit. So that's a lot of wasted money, and it's a lot of immunosuppression that isn't providing any clinical benefit to patients. But if you had a genome and if you had your genotype and phenotype sequenced, you could deselect those patients before you put them on the drug. So I think we're going to see big advances in targeted therapeutics on particular types of cancer. And then we're going to see particular therapeutics that are going to work. We're going to see personalized medicine develop so that we're going to know which of the therapeutics that are on the market today will work best for you. I mean, we can already do it. It's just not happening at scale. And so I think that will become commonplace. And so I think cancer will become more of a chronic disease over the next 5 to 10 years. And I do believe within my lifetime we can see many of these cancers cured.
We have room for one last question.
Bob, thank you so much. And it's wonderful to see that an organization with the brand like this is getting into impact investing. So I'm sure that there are others out there, and then when you guys started, you've done your research of how would this work, given, in a setting and pairing a nonprofit with an impact investing mission. So can you tell us a little bit about what your role is as, with this fund in kind of showing the way to other organizations, in other topics and other matters of how these solutions can be supported through this vehicle?
That's a great question to end on. The American Cancer Society is an umbrella organization, so you've got groups like Leukemia and Lymphoma Society, you've got Multiple Myeloma Research Foundation, you've got National Brain Tumor Society. There's 7 or 8 groups. So a professor at Harvard Business School has convened a bunch of us who are fund managers in this sort of new and emerging disease management space. And so what we're beginning to do is anything that's leukemia and lymphoma related that we see that comes in as a deal, whether it's a deal we want to do or not, we push that out to the Leukemia and Lymphoma Society. Same thing on brain, same thing on pancreas. And so we're starting to try to provide more speed for deals to get done so that all of these groups are able to see more deals at scale, because that's how more deals get done. And so that's one. And then the second thing we're doing is we're all sharing best practices. So like in the past, we wouldn't tell you anything if you were another venture capital shop about who our LPs were, and we didn't want you to go and knocking on their doors and competing with us. But today, we're sharing best practices. We're talking about where we're raising money because impact is very different. Because most people have an affinity for cancer at some level because everybody's been touched by it. Not everybody has leukemia. Pancreatic cancer is a very small disease population. Ovarian is a very small disease population. So, but we don't want those diseases to be overlooked. In fact, we want to play a role in helping find diagnostics and treatments for those diseases. So we are working very hard to make sure that we're distributing, not only as a cancer society, but through these other convening organizations like HBS, we want to make sure that we're bringing value to the whole space. So, because it's still developing. Hey, so can I say just one last thing? So first of all, I'm surprised that the people who have interest in going to venture capital didn't ask any questions. So that's a red flag. And the second is we're looking for interns at our shop. So if you have interest in science, you have interest in investing, finance, we'd love to hear from you. And Dory, I think, has my contact info, and so be happy to pick up a phone, meet with you, and talk to you about it further. But we want to get 2 or 3 interns from Tech and Emory and to be with us throughout the year. So and we will pay you. So all right, thanks. Thank you.